All right. Welcome back. Here we are again, and we're going to go to, yes, you guessed it, find the date by going to the trusty Wall Street Journal. And there we go. Okie dokie. So let's see. All right. Friday, February 22nd, 2013. 6:56 p.m. Eastern Standard Time. Okay, so we're going to pop into our chart, and we'll see how we are making out in our trade. All right, well, we're still short, and this was basically the previous day, yesterday's action right here. We were short at this point that opened. Okay, so we're still we're there, we're short, and this is today's action. And oh, also remember that we did place our break-even stop right up here at 1.32800, and this is today's action right here. There's our stop right here. So our stop didn't get hit, and we're still short, and we're going to stay short. Now there are a number of different ways of looking at this. Again, you could also move, trail that stop even more and move it down here, okay, to this particular level or another level that you chose. That's not very much distance between those, even though it is the the high of today, which makes that a good place. But the interesting thing is that we'll see here is that the on the chart itself is that we opened here and we traveled all the way up here during the day and came back down some, and then we ended up closing right at about where the open is. Okay, so we've had a lot of travel in the upward direction, but not enough upside momentum to stay there. So just saying that to say it, not saying it to mean necessarily that we'll see additional downside action when you're in a trade and you're short like we are from this particular point. That's that's not a it's not a bad thing to want to see more downside action, but we let the trades play out as they may. And when you're looking at a daily chart, again, we could again trail the stop close, but you're typically looking to try to get in on a trend of some sort, and you're not just looking for 10 or 15 or 20 pips. Some people will say, well, get what you can, but there are some moves that happen in the markets, as you well know, and this is all obviously a hindsight move, but the types of moves that you want are all dependent upon which particular trading strategy or methodology you're using. In this particular case, we're just going through entering this particular trade and managing the trade through managing our risk, through managing the stop loss, which was initially here, which has been moved down to here. Okay, so this is a trailing stop. That's a trailing stop moving in the direction of the market. Okay, so should the market come back up and hit this level, then we're out of the trade at break even. Should it continue lower, then what we're going to do is we're going to look to move that stop even lower. And we're going to talk a lot more about the stop and where stops should be, where they could be, and reasons for that. Quite obviously, if you're looking at any of these bars here, you can see that the bars have some range. Okay, and a lot of the bars are over 100 pips, and it's pretty easy for the market to move 100 pips in a day, as you can see in some 200 pips in a day or more, depending upon what's driving the volatility on that particular day. So having a trailing stop of just that's just way too close, and this one is actually truthfully is pretty close based upon the movement of the market, because this is this bar of this particular day is larger than larger than 100 pips. But here we are, and we'll see what happens in this in this next phase. Now the market does go down and get to a level, start to get to a level where we would be in the 200 pips in profit. Again, someone really looking to get in on a larger trend would not mind at all seeing a 200 pip swing. They would rather it not come back and stop them out at break even or anything like that. But they understand that when you're looking for bigger moves, that there are going to be bigger fluctuations in equity, basically. So here we get down to a point where we get 100 plus pips to the good that's per contract. So per standard contract, we're talking about $1,000 per contract. You start having a number of contracts, and then it turns back around and breaks you out even. You might say, oh wow, I had 10 contracts, that was $10,000 I left on the table. We'll be talking also about handling of multiple contract strategies and methods and those types of things as well. But for now, we're doing a single euro US dollar standard contract, $10 per pip. Okay, so anyway, that's it, and we're going into the weekend here. So that's why you see this little buddy right here not moving around. This is a live chart, but there's again nothing happening. So we'll resume again when the market opens again, and we'll see where that takes us in our trade. Thanks a lot, and look forward to seeing you in our next segment.